Welcome, everybody, to the channel. Welcome back. We have some breaking news here. Urgent updates. Regulators close New York's signature bank, citing systemic risks. This is super important, urgent importance, not only as it relates to the impacts to the banking industry, but as well as the impacts to other banks, other businesses, and how this is tied in and interconnected with others around the world, and what we are likely to see coming out of the U.S. Treasury, Janet Yellen, the FDIC, the Fed, central banks, and more, as account holders literally are panicking. Reports coming in of people trying to make it. Sorry, it is windy up here, a little chilly. We got a little bit of a rainstorm going on, but I didn't want to look like a complete weirdo on this video for you guys, but it is a little cool. So just know it's me here. And where reports are coming in that people are actually starting to initiate bank runs now. And lines are building up at ATMs around the country as people are worrying about the ability for them to have access to their funds come Monday morning, even in banks that aren't necessarily specifically directly tied to Silvergate, tied to Silicon Valley Bank, SVB or SIVB, or now Signature Bank, which I want to read to you guys some important information shared by CNBC here just a few hours ago, or just about an hour ago. Actually says it was updated 2 minutes ago, so it is most current. Regulators closed New York's Signature Bank, citing systemic risk. U.S. regulators on Sunday shut down New York-based Signature Bank in a bid to prevent the spreading banking crisis. We are also announcing a similar systemic risk exception for Signature Bank, New York, which was closed today by its state chartering authority, according to a joint statement released this evening by the Treasury, Federal Reserve, and FDIC. Now, also, the banking regulators said depositors at Signature Bank will have full access to their deposits. A similar move to ensure depositors at the failed Silicon Valley Bank will get their money, while all depositors of this institution will be made whole, according to regulators. As with the resolution of Silicon Valley Bank, no losses will be borne by the taxpayer, which is theoretically good news to hear. Now, I'll explain more about that a little bit later, but I want to continue on here so you guys can get this information uninterrupted. The regulators shuttered Silicon Valley Bank on Friday and seized its deposits in the largest U.S. banking failure since 2008 financial crisis, and the second largest ever in history. The dramatic move comes from just days after the tech-focused institution reported that it was struggling, triggering a run on the bank's deposits. Signature is one of the main banks to the cryptocurrency industry, the biggest one next to Silvergate, which announced its impending liquidation last week. It had a market value of $4.4 billion as of Friday after a 40% sell-off this year, according to FactSet. And as of December 31, Signature had $110.4 billion in total assets and $88.6 billion in total deposits, according to a securities filing. And to stem the damage and stave off a bigger crisis, the Fed and Treasury created an emergency program to backstop deposits at both Signature Bank and Silicon Valley Bank using the Fed's emergency lending authority. The FDIC's deposit insurance fund will be used to cover depositors, many of whom were uninsured due to the $250,000 guarantee on deposits. While depositors will have access to their money, equity and bondholders at both banks are being wiped out, according to a senior Treasury official. So, folks, it looks like the FDIC, the Treasury, the Federal Reserve are stepping in to prevent a total implosion of this bank, rippling through the economy, as I will share with you guys in just a moment how this ties into literally everyone. However, I'm not 100% certain if the FDIC will cover deposits over $250,000. We will see. I got a few more tabs to go through here, as well as this is also ironically happening on a Sunday, as we previously heard reports that the FDIC stated that banks would collapse on a Friday, which we actually saw happen with Silicon Valley Bank, SIVB or SVB, on Friday collapsing. This one happening on a Sunday. So now it's kind of like all bets are off. Anything and everything could potentially happen. What I would say is most important moving forward is making sure that you have a plan of attack, you are diversified, you are secured, and you have cash flow coming in. Huge, folks. Wall Street Journal. Signature Bank is shut by regulators after SVB failure. Failure, I want you guys to see this. Failure of real estate lender hobbled by crypto bet is third largest in history. Cryptocurrency, very, very dangerous, very risky, especially for those who don't understand what they're doing and are literally getting in just to try to make a quick buck and get rich quick. This is a problem. Signature Bank was closed by regulators on Sunday, the second massive bank failure in 3 days. The New York based bank faced a crisis. I don't have Wall Street Journal, so I'm going to read this little blurb here that I can see before it goes away. And it says that the New York-based bank faced a crisis of confidence after mid-sized lender SVB Financial Corp was seized by regulators on Friday. Signature was also reeling from a bet on crypto banking that foundered after the sector imploded and banking regulators cracked down on lenders' exposure to digital assets. The failure is the third largest in history and only the beginning, folks, of what we're likely to see happening with these banks as they experience losses in this risky world of decentralized cryptocurrency, on top of the already expressed issues that Silicon Valley Bank faced with the rapidly increasing and rising interest rates pushed by the Fed to fight inflation. So I don't want you guys to forget that. Meanwhile, CBS News reports that regulators closed New York's Signature Bank following Silicon Valley Bank collapse. Now, this is not necessarily just a repeat of what I just said, but it is very important, and more so because it's going to tie in. And please ignore the banner up top here. I am not hashtag not sponsored. I don't even know where that came from. I can't get rid of it. There's ads all over this website by CBS. They're trying to make that ad revenue. But this is tied into banks all around the world. Okay. The New York Department of Financial Services announced Sunday that it has taken possession of the Signature Bank and appointed the Federal Deposit Insurance Corporation, the FDIC, as the bank's receiver. And basically, what that means is they've literally turned this bank into a central bank. This is the beginning of CBDC, folks. So the move comes 2 days after Silicon Valley Bank collapsed as depositors rushed to withdraw funds. As I mentioned, the liquidity crisis that they face as a result of the tech sector, massive job loss, massive job cuts, layoffs, terminations, firings, hiring freezes, forced this bank's hand in a position where these tech companies were unable to gain access to funding, capital, lending, loans, or at a rate that they could afford to repay. So instead, they chose to go to these banks, Silicon Valley Bank being one of them, with many, many other banks on my list, on my radar, to further investigate and bring you guys updates and information on the potential likelihood of their collapse, who may or may not survive. But what they did was they moved to withdraw their own cash from their banks to then be their own bank, to then fund their own operations instead of relying on lending, loans, and debt, which then put Silicon Valley Bank into a liquidity crisis situation where they had to then sell off at a loss to be able to satisfy these withdrawal requests, forcing the collapse. Now, with that being said, the CEO of Silicon Valley Bank dumped $3.6 million worth of stocks 2 weeks before. Coincidental? You guys let me know. Drop a comment down below. The bank is FDIC insured and had assets of around $110 billion. And all depositors will be made whole, according to the Federal Reserve, Treasury Department, and FDIC, which they said today in a joint statement. I'm really wondering if they're leaving out the caveat of made whole up to $250,000, made whole up to the $250,000 limit. Time will tell. The banks are supposed to open tomorrow on Monday. We shall see. I have my opinions on that. There could be some potential risks involved, safety concerns, and I wouldn't be surprised if we saw multiple banks outside of Silicon Valley Bank, outside of Signature Bank, that may or may not open. So shareholders and certain unsecured debt holders will not be protected. So some will be wiped out. And according to the agency, senior management has also been removed. Any losses to the deposit insurance fund to support uninsured depositors will be recovered by a special assessment on banks as required by law. And the joint statement also said that Silicon Valley Bank depositors would have access to all of their money beginning Monday. And for both SVB, Silicon Valley Bank, and Signature Bank, no losses associated by the resolution of the banks would be borne by the taxpayer. But I feel like they're going to reverse that and change it in some way, some form down the road. Right now, they just want to put the fire out, basically. Earlier on Sunday, Treasury Secretary Janet Yellen told Face the Nation that the federal government will not provide a bailout for SVB's investors. And also, we're not going to do that again, is what she said, but we are concerned about depositors and we're focused on trying to meet their needs. Um, a lot of people are possibly misinterpreting what is being said here. Some people are saying that Janet Yellen is bailing out the banks, and others are saying that she's not bailing out the banks. But at the end of the day, what they're doing is they're focusing on the depositors, the FDIC insured depositors. And it says here, we're not going to do that again. So it looks like she's not interested in bailing out SVB investors. Okay. So this is going to be, maybe there is a bailout, but for some, not all. Okay. Which is, again, diversity, security, cash flow. Folks, be careful, be aware, become better educated, more intelligent, do your homework, do your research on what is going on and where you're putting your money. After Reuters says after SVB failure, the U.S. acts to shore up confidence in the banking system. Reuters says here that the U.S. administration stepped in on Sunday today with a series of emergency measures to shore up confidence in the banking system after the failure of Silicon Valley Bank threatened to trigger a broader systemic crisis. And this broader systemic crisis is going to occur across the tech sector, across U.S. banks, across investors, and around the world. Please stick with me. I got a lot I want to share with you guys. CNBC, Japan's topics falls 2%, leads losses in Asia as U.S. seeks to stem risk from Silicon Valley Bank. Silicon Valley Bank is having an impact in Japan, okay? It's having an impact in Asia, all right? And it says here that Asia Pacific markets fell on Monday as U.S. regulators announced plans to backstop both depositors and financial institutions associated with Silicon Valley Bank, seen as a move to stem further systemic risk. They are literally telling you right here what's going on, what's happening, what they're afraid of, what they're preparing for. I don't know if you guys can see that. The highlighter's a little light, but further systemic risk. Silicon Valley Bank last week was shuttered by regulators after customers withdrew a staggering $42 billion of deposits by the end of Thursday. And reports have come in that people are now trying to access their banks, their ATMs, trying to do all they can to pull out as much money as possible, only to be prompted with a message, a notification, an alert, an announcement, an update that their account withdrawal limit has been reduced significantly, like down to like a few dollars. Okay, the banks are in self-preservation mode, basically. In Japan, the topics fell 2.17%, leading losses in the region as shares of SoftBank saw a drop of more than 2% as investors continue to assess contagion fears. The Nikkei 225 fell 1.75%, and in Australia, the S&P ASX 200 fell 0.55%, with banks continuing to see declines. So this is the systemic risk that they were talking about, folks, and this systemic risk is widespread. And in China, its National People's Congress is slated to conclude with a scheduled press conference. Overnight, stock futures of the major U.S. indexes jumped on Sunday evening after the backstop announcement, with the S&P 500 futures gaining 1.18% and the NASDAQ futures up 1.35%. And I do believe there's speculation that the markets are going to be crazy tomorrow. But, you know, you do what you do. I buy on down days. I buy on red days. I buy to hold. You do what you do. But now's not a time to panic. The U.S., according to NPR.org, the U.S. takes emergency measures to protect all deposits at Silicon Valley Bank, which is a plus. People should have some comfort in knowing that this is happening. However, we should all be realistic and not naive in understanding that what is happening and what we are ultimately signing up for and asking for of a CBDC, central bank digital currency. Now, it says here that the Biden administration has announced that customers of Silicon Valley Bank will have full access to the deposits, an extraordinary move by federal officials to backstop billions of dollars in uninsured money amid fears that the bank's collapse could lead to greater panic. Federal regulators said Sunday that it was taking the emergency measures to prevent contagion at other small and regional banks in the wake of Silicon Valley Bank's sudden implosion. And this is what I was talking about. People are going to banks and trying to withdraw money out of their bank, even though their bank isn't necessarily tied into Silicon Valley Bank directly. This contagion, this systemic risk is growing. People are getting afraid, they're panicking, they're worrying. Federal regulators said Sunday that it was taking the emergency measures to prevent contagion at smaller regional banks in the wake of Silicon Valley Bank's sudden implosion. The rescue plan involves tapping a deep reserve of bank funded federal insurance money, not taxpayer dollars, according to officials. But if the FDIC, if the Federal Reserve, if the U.S. Treasury, if Janet Yellen decides to make depositors hold with Silicon Valley Bank, with Signature Bank above the $250,000 FDIC insured limit, this is going to have a major impact on the viability of people having a safety and security net in the future through the FDIC, because their funds are going to be depleted rather quickly. The regulator said customers of Silicon Valley Bank will be able to access all of their money starting Monday, which there is no real clear information on where they'll be able to access their money. So I'm assuming it's still through Signature Valley Bank, as it is under the control of the Fed, Federal Reserve, the FDIC, until perhaps maybe it gets acquired by another bank. Now, it says that deposits at Signature Bank, which was shut by New York regulators today on Sunday, would also be backstopped. The closure of Signature represents the third U.S. bank to topple in just 3 weeks. 3 weeks. I'm sorry, the third in just 1 week. Just 1 week. I'm sorry. 1 week after California-based Silvergate, a top lender in the crypto market, decided to wind down its operations and pay back depositors. But we've seen 3 banks in 1 week. Folks, this is concerning. This is alarming. And according to federal officials, they made a statement today that says that today we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. And this step will ensure that the U.S. banking system continues to perform its vital roles to protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. You can see Janet Yellen here holding up a sign, or maybe she's trying to cover her face. I don't know. But, I think that she is worried, too, about what's happening and what is likely to occur, while also trying to fight through this federal debt crisis, debt ceiling limit crisis, and other liquidity issues that are happening while the U.S. is continuously just recklessly spending and sending billions and billions and billions of dollars to other countries. It's beyond me. I don't understand it. Now, it says here that until the announcement, there was widespread fear among depositors of Silicon Valley Bank, since federal insurance covers accounts up to $250,000, and more than 90%, more than 9 out of 10 of the bank's deposits were above the cap. Most customers of the bank were tech startups and firms tied to the venture capital world. Therefore, they have funds in their accounts, their balances, their ledgers exceed the $250,000 FDIC insured limit, and that's a lot of money to be lost. But it says here that administration officials and financial regulators worked through the weekend, and according to the senior Treasury Department official, to shore up confidence in the banking sector before Monday. Now, is this real confidence, or is this like propped up, phony confidence? It says that banking analysis or analysts worry that Silicon Valley Bank's rapid insolvency would trigger uncertainty among depositors of other small and regional banks, leading federal officials to take steps on Sunday aimed at fending off other potential bank runs that could inflict deeper economic damage. That would be the multiple bank runs that we could potentially see from other banks as people worry, panic, and are fearing getting prepared for their bank, possibly locking them out, shutting them down, wiping them out. In a separate statement, President Biden said those quote-unquote responsible for this mess will be held accountable, and he plans on delivering remarks on Monday on how the U.S. can continue to maintain a resilient banking system. And I will be front row and center, virtually, of course, because I really want to hear what he has to say about that, or at least what someone wrote that he's going to read on a teleprompter to say about that. And it says that stock and bond investors of SVB will not be protected, and the move on Sunday effectively waives the $250,000 ceiling on federal deposit insurance for Silicon Valley Bank and Signature Bank. So there it is. It's finally somewhat clarified here. The move on Sunday effectively waives the $250,000 ceiling on federal deposit insurance for Silicon Valley Bank and Signature Bank. So the FDIC is going to make everyone whole as a depositor, not investors, not stock investors, not bond investors, but the depositors. This is huge, folks. This, I don't know if you guys understand just how big this really is, but it says that the deposits will be supported by insurance funds, not taxpayer money. And a senior Treasury official on Sunday stressed Silicon Valley Bank's investors will not be provided with any relief by Sunday's actions. Therefore, they are SOL. And the bank's equity and bondholders are being wiped out. Okay. They took a risk as owners of the Social Securities. They will take the losses. So they're probably going to offset some of those losses in these bond and equity these bondholders, these investors, and they're going to use that to prop up some of the depositors. I'd be willing to bet. Now, the Federal Reserve also announced on Sunday that it is taking new steps to make funding available to banks to cushion any potential risk prompted by Friday's collapse of Silicon Valley Bank. And today, we are taking decisive action to protect the U.S. economy by strengthening public confidence in our banking system, according to officials on Sunday. I don't know if this really provides more confidence in the banking system or more confidence in the fact that we can just continuously make up money out of thin air. But it says that the rapid meltdown of Silicon Valley Bank happened at a stunning pace, as did the government's response. Like they kind of knew this was going to happen. The lender's stock price plummeted on Thursday, and trading of its shares were halted early on Friday. Hours later, California banking regulators shuttered the bank and appointed the Federal Deposit Insurance Corporation as receiver of nearly $175 billion in customer deposits. During the pandemic, the tech sector's boom led to a surge in deposits at Silicon Valley Bank, and the bank then invested a large chunk of the cash into long-term government securities. The value of those securities began to drop after the Federal Reserve started raising interest rates aggressively to fight inflation. Those rate hikes came just as there was contraction in funding for startups. Tech companies were spending company cash fast, and they were having a hard time replenishing the funding in the face of a challenging fundraising market. You guys may recall Elon Musk was trying to sell furniture and artwork out of the Twitter office. He wasn't able to pay some of his bills and rent and lease payments on time, facing eviction. And then that in turn led to startups pulling out more and more cash from Silicon Valley Bank, forcing the lender to sell part of its bond holds at a steep loss of $1.8 billion as they were attempting to satisfy these withdrawal requests. The announcement of the bond sale sparked more depositors to pull out their funds, effectively leading to a bank run or a run on the bank. Nothing draws a crowd like a crowd, So this panic and this fear and these withdrawals incited more bank runs, more withdrawals. Venture capitalists, including Peter Thiel's prominent Founders Fund, advised customers to pull deposits out of the bank, adding momentum to a bank run that set off the bank's swift collapse. Yeah, thanks for sounding the alarm there. Tech CEOs were pleading for help as federal officials scrambled over the weekend to try to prevent a larger financial fallout from the bank's demise. The venture capitalist community took to Twitter with doomsday predictions, claiming the failure to back up deposits could lead to a catastrophe for tech startups and venture capital firms. More than 5,000 startup CEOs and founders pleaded with federal officials for support as reports circulated of startup founders unsure of how they would be able to pay employees if their money was tied up in the insolvent Silicon Valley Bank. And I would be willing to bet that this systemic banking risk, this bank collapse, Silicon Valley Bank, and others to follow, would potentially lead some of these tech companies to initiate even more layoffs so that they can reduce their overhead operating payroll liability expense moving forward. Just my guess. Now, we are not asking for a bailout for the bank equity holders or its management. We are asking you to save innovation in the American economy, according to the founders and CEOs who wrote in the petition and said Silicon Valley Bank's failure has a real risk of systemic contagion. Fight fire with fire, basically. These folks are afraid, they're worried, they're panicking, they're scared, and they're going to use that as their firepower against the Fed, against the FDIC, against the U.S. Treasury. Meanwhile, the Washington Post reports that the U.S. says all deposits at failed bank will be available Monday. Regulators also closed down Signature Bank of New York on Sunday today and said they are extending protection to those depositors. They've moved very, very quickly, very rapidly. No delay here. The Biden administration announced Sunday that all depositors at the failed Silicon Valley Bank would have access to all their money on Monday morning, approving an extraordinary intervention aimed at averting a crisis in the financial system. And authorities said that they were also extending protection to depositors of a second bank, Signature Bank of New York, which state regulators closed on Sunday as unease in the financial sector spread. Separately, the Federal Reserve announced that it was creating a lending facility for the nation's banks designed to buttress them against financial risk caused by Friday's collapse of Silicon Valley Bank. Fed officials declined to provide a specific figure for the size of the new loan program, but made clear it would be large enough to cover trillions of dollars in potential requests. Now, the series of crisis maneuvers by federal authorities announced just hours before the start of trading in Asia reflected the fear that has rippled through the banking sector just a few days after the collapse of Silicon Valley Bank, which many financial experts thought initially was an isolated episode. And this is that systemic risk rearing its ugly head again. And the decision by Treasury to backstop all deposits at SVB and Signature, not just those up to $250,000 that are insured under federal law, rested on a judgment that it was necessary to avoid a wider systemic meltdown. I don't know where they're getting this money from, folks, but somebody's going to have to pay for it. Now, the move will likely ignite a political firestorm over the decision to protect the assets of tech firms, venture capitalists, and other rich people in California. Their words, not mine, folks. I'm just reading it right here from the Washington Post. And it also says that today we're taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. A joint statement from the Treasury Department, the Fed, and the Federal Deposit Insurance Corporation said this step will ensure that the U.S. banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. That worries me, folks, because if people out here know that that's what they're going to do and that's their role, what's to stop them from making this happen, knowing that somebody's going to come in and save the day? Not all heroes wear capes, folks. Now, on a call with reporters on Sunday evening, a senior Treasury official defended the administration's decision as necessary to stabilize the banking system and said that the move would protect companies and workers who could be harmed by the bank's collapse, not the bank's shareholders or executives. They're screwed. Now, the official spoke on the condition of anonymity to describe internal deliberations, and the decision to protect all deposits was made following unanimous recommendations by the boards of the Federal Deposit Insurance Corporation, the FDIC, and the Federal Reserve, the nation's top banking regulators. President Biden was also consulted on the announcement in between ice cream cones. And the American people and American businesses can have confidence that their bank deposits will be there when they need them, according to the president and what he said. And I am firmly committed to holding those responsible for this mess fully accountable and to continue our efforts to strengthen oversight and regulation of larger banks so that they are not in this position again. I love to see how he's going to pull that one off. Now, the president said that he planned to speak on the banking system Monday morning. And it says here that Jacqueline Reese, Chief Executive Officer of Lead Capital, a Kansas City-based bank, and a former executive at payments company Square, says, "I am very relieved. And the startup companies that had their money at SVB are important for job growth and innovation. Because, if they collapse, it would make this recession, oh man, it would accelerate this recession so hard, it'd be unbelievable. High inflation, recession, job loss. We've got the banking system collapse. The dollar losing its strength as a world reserve currency. Like, this would be epic." Treasury Secretary Janet Yellen said that taxpayers would bear none of the burden of protecting depositors. Their funds will be backstopped by a pool of money that is regularly paid into the U.S. banks, which now holds more than $100 billion. Uh, they're going to go through that relatively quickly, folks. And the new Fed program will enable banks to pledge U.S. Treasuries and other safe government securities as collateral in return for loans of up to 1 year from the central banks. The initiative is aimed at resolving one of the problems that led to SVB's failure, which is unrealized losses on the bank's government securities. As the Fed raised interest rates last year, the value of those securities fell. Well, that's called quantitative tightening. That's what Jerome Powell said. Pain will be felt by families and businesses. And guess what? Banks are businesses too. Meanwhile, industry-wide, banks at the end of last year reported $620 billion in such paper losses, according to the FDIC. Banks don't actually lose money if they hold those treasuries until maturity. But if they must sell them to cover depositor withdrawals, then those losses appear on the books. That's just a fluctuation of the values and the how much they're worth basically at the time of which you decide that you want to buy and or sell, which is what I was telling you guys about now, which previous videos about people trying to liquidate now to gain access to cash. Now is not the time to do that because everything you sell now is going to be at a discount. However, if you're looking to buy, if you're looking at investing, if you're looking at gaining access to these assets at a discounted rate, it's a great time to buy. Now, the Fed's loan terms are more generous than its traditional 90-day lending channel, and the central bank will lend up to the security's original value rather than its depressed market value, thus potentially allowing banks to delay recognizing their losses for up to 1 year. But we're just kicking the can down the road here, folks. Meanwhile, the new program and the Fed's support for the SVB and signature measures represent classic central bank panic actions. And according to a Fed official, this is what he said. He said, who briefed reporters on the condition of anonymity, classic central bank panic actions. Claims that the decisions do not amount to a bailout, however, are likely to be challenged. While the funding going to the depositors is paid into the U.S. banks, it is ultimately backstopped by the Treasury Department and therefore U.S. taxpayers, which is like I told you guys, they're going to come back and make taxpayers pay for this somehow, some way. It's just that right now they can't put it out there like that because then there would be massive uproar, okay? Treasury Executive, or I'm sorry, Treasury's Exchange Stabilization Fund also will provide $25 billion to backstop the Fed loan program, though officials said the central bank does not anticipate that it will be necessary to draw on these backstop funds. Now, according to according to reports by Senator Bernie Sanders in a statement released, now is not the time for U.S. taxpayers to bail out Silicon Valley Bank. If there's a bailout of Silicon Valley Bank, it must be 100% financed by Wall Street and large financial institutions. We cannot continue down the road of more socialism for the rich and rugged individualism for everyone else. Well said, Bernie. Sunday's actions mark the most expansive use of Federal Reserve Authority since the early days of the pandemic, when the central bank established several protection programs to ensure that credit continued flowing to employers and consumers. Uh, Folks, long story short, we are in the middle of this systemic banking crisis risk. And I do want to cover more of what I have here for you and not keep you here all night. So we're going to move on, but I can pick this article back up later. But the way that this systemic risk actually permeates through the economy and through other businesses is just what we see here. Etsy warns sellers of delay in processing payments due to Silicon Valley Bank collapse. And it says that Etsy is warning sellers that the collapse of Silicon Valley Bank on Friday is causing delays in processing payments, according to an email from the company shared with NBC News. And the online do-it-yourself goods megashop said it used SVB to facilitate disbursements of some sellers and that it was working with other payment partners to issue deposits. Therefore, Etsy's diversity plan. Diversity, security, cash flow, folks, remember, it says that Etsy claims 7.5 million sellers worldwide. Regulators placed SVB into receivership around noon on Friday to end a bank run on the tech lender that had begun Wednesday after it said it was seeking to raise more than $2 billion. So, yeah, robbing Peter to pay Paul, but at the end of the day, the effects are going to be widespread, not just to those directly tied to SVB, Silicon Valley Bank, or now Signature Bank. And we can see here that U.S. bank shutdown expected to affect New Zealand's share market. So this is going international, folks. Banking experts say Kiwis deposits would not be protected if New Zealand Bank was to collapse. So this systemic risk is spreading, folks. It's getting a hold and it's just seeping through. Bank collapse. Local shares fall on Silicon Valley Bank contagion fears, and Wall Street Journal reports here that First Republic hit by Silicon Valley Bank failure. We've got a lot to cover here. I'm going to save this for a separate video because I think that maybe this one might be all that we can really digest at the moment for what's actually going on, what's happening. If you guys got any questions, comments, concerns, please drop them down below in the comment section. Let me know. I'm going to continue to monitor this. I'm going to do a deep dive. I'm actually planning on hitting up banks tomorrow and credit unions tomorrow to start asking some questions and getting some better understandings and kind of like a feel, like a vibe for how people are their mannerisms, their body language, their actions, if these banks are even open. So you guys stay tuned. Make sure you subscribe to the channel, turn on your alerts, give this video a like, share with anybody you think this would be helpful and beneficial to, and you guys take care, be safe. I'll see you real soon. Bye.